Hello, fellow Rebel Capitals. Hope you're well. I am back with my good buddy, Joseph Wang. Joseph, we've got a lot to talk about, my friend. First and foremost, tell us what's going on with the jobs data. And then I want to get into Trump firing the gal or wanting to fire the gal. All this drama. What on earth is happening in the world right now?
Well, first off, it's good to see you again, George. And like you mentioned, there's a lot going on in the macro world. So let's start with the jobs data. So today was Jobs Friday, and we got kind of a shocker here. So on one hand, the headline jobs number missed. It was, a bit below what was expected. I think the street was expecting around 100,000, and we got 70,000. But what was really shocking was the downward revisions.
Right.
So last month we had a much better than expected jobs report, and this current report basically revises all those jobs away. And so it's painting a picture that when it comes to jobs, the economy is not doing as well as everyone thought. Now, just to give you a little bit of context here, we also had the Fed meeting the past week, and Jay Powell was resolute that he doesn't want to cut rates. One of his biggest arguments is that the economy is fine. Job market is great. Inflation's a little bit above target. And so obviously we got to hold rates where they are, right? We are a two mandate bank. We want inflation to be low, and also we want the unemployment rate to be low right now. Right now, job market is fine, inflation too high. So we got to be a little bit tight when it comes to policy.
Right.
So this jobs report kind of blows that narrative all away because it paints a picture of a job market that's weakening. Now, this is not the only data print that supports this. So if you look at the ADP jobs reports, ADP is a private payroll processor. So this is from the private sector. And every month, so if you work at a private company in the US, oftentimes you get your payroll payments from ADP. So they have really good data. And the ADP has been saying the same thing over the past few months, that the labor market is weakening. Now, on top of that, so there's kind of a little bit of a civil war going on the Fed board, where you had two people dissent on the FOMC, and those people were dissenting because they were telling Jay Powell that the labor market is weak. So we got to be careful here. Things are not as good as it sounds. So today's jobs report, I think, gives a lot of evidence towards that perspective, and the market is reacting strongly because now they're pricing in a lot more Fed cuts, simply because if the labor market is weakening, well, obviously the Fed has to do something about it.
Yeah, their dual mandate, going back to what you're talking about. How do you think that drama will play out? And just to expand on what you're talking about so the audience really understands the gravity of what's happening right now. So this is the first dissent that we have had, I believe, since 1993. So now that we get this weak jobs number that backs up what Waller and Bowman are saying, or were saying, are they going to come out now in the media and say, I told you so, and raise their hand and say, hey, Trump, you should hire me and I should be in there instead of Jay Powell? Or how is this soap opera going to play out, do you think?
So we had a tweet today, as you mentioned. President Trump is saying that, yeah, we got to fire this the data person at the labor bureau because they're pumping out data that he doesn't like.
But here, I'm actually confused on that.
Yeah.
Because when I first heard that, in fact, I just had lunch with Jeff Snyder, our good buddy, and his take was Trump wanted to fire this gal because she downwardly revised the numbers, implying that the economy isn't as strong as he's saying. But my take was, no, he's firing her because if you have to keep doing these revisions, obviously you're incompetent. Like if the headline number is this wrong, the person in charge is doing a bad job, they're incompetent. So do you think Trump fired her or wants to fire her because of incompetence or because he thinks she's trying to politicize the numbers?
I think his tweet suggests both. Now, I don't know this person at all, so I don't know if she's competent or not. And like you mentioned, we do have a lot of revisions, and maybe that's not her fault. Maybe it's just because the data is fuzzy because we have all these things happening in the economy, right? Or immigration policy, big changes there. So
Right.
it's hard to take account of like 3 million illegal immigrants coming in a year and now zero. But on the other hand, we also know that a lot of people in the Biden administration were not super honest, right? A lot of them were going around telling everyone that Joe Biden, sharp as a tack, super smart, right? Young and dynamic. And we know that's all nonsense. So I don't know what to say. I mean, it looks bad for a president to try to get rid of people who who produce data that he doesn't like, but maybe there is something wrong with the data. So I don't know. I'm gonna, I guess,
How do you
see how
think it's
that
going to
plays
play out
out.
how do you think it's going to play out with Bowman and Waller? Because they were the two that dissented,
Yeah,
and so
well,
now they can kind of wear that as a badge of honor.
so these two people. Let's be clear; these two people are both Trump appointees. Now, for Governor Bowman, I think it's more political because Bowman is someone who is pretty hawkish. So all throughout the past few years, she was literally the most hawkish person on the FOMC.
Oh, I didn't
Like,
know that.
yeah, the inflation was coming way down. Everyone was like, "We should cut a little. We should cut a little." She's like, "No, no, no. We gotta keep it hot. Maybe we'll keep hiking."
Okay.
And so everyone was kind of, honestly, she was kind of almost cartoonish, hawkish. So her sudden change of tone, I think it's just her being a team player, because she was recently promoted by the Trump administration. Now, Waller, though, I think he's making a good argument. So Waller was someone who was on top of the monetary policy the past few years. So everyone was saying that the Fed would hike us into a recession, really bad. But Waller, he's like, no, this is not going to happen. What's going to happen is that we're going to hike and the number of job openings is going to decline. So the unemployment rate won't go up. It's just that there'll be less demand for labor. And so we're going to have inflation come down without the unemployment rate go up too much. And he's been completely right. Now, he's saying that we should cut rates now for two reasons. He's saying that one, the labor market is not good. We're just talking about that, George. But the other thing that he's talking about is that, tariffs, they probably will make inflation go up a bit, but it's just a one-time increase in the
Right.
price level. It's not like the rate of change is going. Now,
Yep.
this type of thinking is standard economics, and it's what Chair Powell talked about too, a few years ago. So Waller is actually being pretty principled. So I don't think so. I want to be clear. He wants to be a Fed chair. There's no doubt about that. But what he's saying here makes sense. And it kind of makes me think that it's the other people on the FOMC that are kind of changing their tune and being a bit more political, because standard economics is tariffs, one time change in the price level, it's transitory, you look through it. Now, a few years ago, we had Joe Biden do that huge stimulus bill, right? Like $1 trillion spending. And everyone there was telling you that we shouldn't do anything because inflation is transitory. We'll just wait and look through it. Now, today, we have tariffs that are much smaller than the huge spending we did a few years ago. And then everyone's saying that it's maybe not transitory. So I think that that's just really inconsistent to me. And so that strikes me as weirder than what Waller saying we should cut rates today.
Yeah, but both times the majority is kind of off sides. I think a lot of people will look at that headline number, like a lot of average Joes and Janes, and they see 4.2 and they see that it was 4.2 last print. And they're like, Joseph, what are you talking about? Like, how can the labor market be weakening if the unemployment rate is 4.2%? So, if you could dive into how that number is calculated, because I think there's a lot of confusion there, and that it's actually the household survey and that the labor force participation plays a big role.
Yeah, so the unemployment rate is basically, are you trying to find a job but you can't find one, and then and you want to divide it by the people who are actually looking for a job, like people in the labor force.
Mm-hmm.
So you're right that it's been 4.2% the past 2 months, but one of the reasons why it stayed at 4.2% is the labor force participation, as you mentioned, the number of people in the economy that are looking for a job, that's shrinking.
You're right.
So what it seems to be is that some people potentially could be trying to find a job, just couldn't give up and dropped out of the labor force. And so in effect, decreasing the supply of labor. And that's why you're kind of artificially making the unemployment rate look low, simply because more people are giving up hope and the labor force itself is shrinking. So
Yeah.
that's one possibility. There's a chart by Parker Ross on Twitter today, and he was showing that if the labor force had not been shrinking these past few months, if labor force had been maintained at the same percentage, the unemployment rate would be 4.9%. So that's a big difference. So that shrinking labor force participation is doing a lot of work in keeping the unemployment rate low.
And I think the pushback there is, well, we're so rich and everyone's in the economy is doing so well that people are just retiring, and they're retiring earlier, so they're leaving the workforce. But what I like to point out is the household survey shows that the number of jobs that we have in the United States is decreasing substantially. In fact, if I'm not mistaken, the household survey today showed like a negative 300,000, something like that. And a couple months ago, it was like a negative 700,000 jobs that we had. And again, the unemployment rate didn't go up because the labor force participation rate went down. But if you just think about that, like, is a strong economy one where fewer people are working and producing goods and services, or where more people are working? And obviously, the answer is where more people are working and producing stuff. Because even if you do retire, you're probably not going to be producing a lot of stuff. You're probably not going to be adding to the economy other than just pure consumption. And at the end of the day, that's not a healthy economy. That's not what we want. So I think it's a more accurate reflection of the overall economy if we look at how many people are actually working that are in that age range, and how many jobs we have, as opposed to just the unemployment rate.
Yeah, that makes sense. And I'll also add that, we have two kind of big structural shifts that are happening. One is that we have a lot. So the reporting is that AI is able to do so much that they're not hiring as many people because the
Yeah,
same
yeah.
person can do more work. So that's one thing. And also we got changes in immigration policy such that the population is not growing as much. So if you're using like a statistical model to try to figure out how things are going, those changes might throw it a bit off.
Yeah, that makes a lot of sense. It's funny you say that, because I hired this kid on YouTube as a consultant for me doing a new sales page for Rebel Capitalist Pro. And what he did is he wrote all this copy and I saw it. I'm like, wow, that is really good. And back 2 or 3 years ago, I know for sure you would have had to have paid a copywriter probably $50,000 to write that copy. And I'm like, I won't mention his name, but I'm like, how did you do that? Because that is just phenomenal copy. He's like, well, I used AI.
Okay, now I don't need you anymore. Tell me what the AI you use, right?
But what he did is he took like transcripts from about 20 of my videos, and then he trained a GPT or something like that on the transcripts. And then AI could immediately determine what kind of the customer avatar is for Rebel Capitalist Pro and write this a copy very, very efficiently. So it just goes back to kind of what you're saying there, more when we zoom out, probably not applicable to today's job numbers, but something that's going to be a big factor, in my view, over the next, call it 3 years or so. What do you think the probability is the Fed drops in September? And do you think we've got a much stronger probability that they'll drop by 50?
Yes, absolutely. I think 25 is almost a lock for September.
Okay.
And if we look at but whether or not we get 50 depends on the next jobs report. We got another one before September. So I think that's how I'm looking at it right now. So yeah,
Well,
right now we have tariffs going into effect today, and
okay.
so and tariff rates have gone up. Right, we had this 10% interim tariff rate. Now it's going to go up for a lot of people. So that I think that should have some impact. It's like a tax, right? So you raise taxes on businesses and consumers, and you would expect some kind of economic effect on their activity, maybe less employment or something like that. So yeah,
Jeff,
I think 50 is a good chance.
how are you looking at the GDP print? Because we had the negative 0.5, but there's just so much activity there that was outside of the norm, with people front running tariffs and everything. And then you have this massive deficit or trade deficit, which is a negative. It's a drag on GDP. So then we have kind of the opposite, where we have the trade deficit go down a lot lower, which is adding like 2.5% or whatever it was to this quarter's GDP. So what are your thoughts on how it was distorted? And do you think in Q3 we're actually going to get a number where there's a lot more signal and a lot less noise?
So, like you mentioned, we got a negative 0.5% GDP print first quarter, 3% surprisingly strong print the second quarter. And a lot of that is because of all this weird stuff happening with
Yeah.
trade, right? Imports, exports, inventories. So, an easy way to just kind of roughly ballpark it would be to average those two numbers together. And so you'd get positive growth of 1.25% the first half of the year. Now, that's notably below where we've been growing the past few years, right? Past few years, 2.5, 3%. So it's a very clear step down in growth, and the economy has been slowing. Now, going forward, so one of the things that people pay attention to when they look at the GDP print is something called final sales to domestic purchasers. So that's kind of what people think of as core GDP print. So it's not looking at imports, exports, stuff like that. And that printed pretty weak too for the second quarter. And so that plus upcoming tariffs, that suggests to me that GDP is going to be pretty weak in the second half as well. So we're in this transition phase where the economy is going to adapt to all these big changes in supply chains, in tariffs, and fiscal policy, stuff like that.
What do you think about Trump getting a yes man in there or a yes woman? And this idea he wants rates at like sub 1%. So I know for those of you who don't know, Joseph is a Fed insider. He worked at the New York Fed's trading desk. So he's got a much better insight as to how the politics work at the Fed and kind of their standard operating procedure for coming to rate decisions. So I guess my first question would be if he gets a yes man in there, like Besant, that's like, sure, you want 1% interest rates? You got him. like how possible is it? Is it really a committee? Does he need to have a majority vote? Or is it like a dictatorship? How does it actually work in practice?
So it is a committee, but the chair is, first among equals, as they'd say in the Soviet Union. So chairs are super influential and can build consensus, shape the message, and so forth. The relative power, I think it varies from era to era. Like during the Greenspan era, I'd say Alan Greenspan much more important than the other people.
Okay, he
Or
calls the shots, yeah.
yeah, or let's say, you know, in other areas, certain other governors, let's say in the very beginning, Benjamin Strong of the New York Fed ran the show and much more influential than everyone else. So it's going to depend on the context here. So if we just had a yes man into the Fed chair role, he probably wouldn't have as much of a sway on the other members. And so I'd say as Fed chairs go, probably relatively weaker, simply because everyone would perceive him to be someone who's political.
Okay. So
But
even if you wanted to take it down to 1%,
no, but I think he could still make a big difference, though.
okay.
Now, the Fed has a lot of discretion the way it sets monetary policy because of its dual mandate. So you have full employment and price stability, right? You could easily have a Fed chair that goes around telling everyone, yeah, inflation's a little bit above target, but think about the unemployment rate. It's going higher. Think about all the people that might be hurt. Think about the ordinary Americans and so forth, right? So have a slightly higher weight on employment mandate than inflation, and you can sway people to being a bit more dovish.
Yeah.
Or, and this is what happened in 2021, you could just say, yeah, we got these tariff inflation shocks. Yeah, transitory. Come on, haven't you read your economics textbooks before? It's transitory. So we should ignore it, right? We should be a little bit more dovish. So you can make these arguments. So who is Fed chair? Who's there in the room? Being able to push consensus, that matters. You can't go from suddenly and get 300% basis point cuts, but you can, I'd say, get an extra one or two more cuts than someone who's a bit more hawkish could. So it does matter.
So it depends on how good they are at manipulation.
Well, you can say manipulation. You can
That's
just
a
say
harsh
persuasion. So one thing I'd also add is that if you just think about the Fed as an organization, it's government, right? Fed is government.
Right,
It's filled with people who went to graduate school. It's based in big cities. This is all demographics of Democrats, right?
Mm.
And you can go and look at public donation data. If you donate, right, your name is listed in a federal database. I'd say almost all donations in the Federal Reserve System by Fed employees go to the Democrats. So it's a very blue organization. So it's not surprising to me that when Biden was president, they'd be like, yeah, whatever, huge $1 trillion deficit spending, that's just transitory. Don't worry about it, right? So the Fed is obviously a political organization. People are political, right?
Right.
Personnel was policy. You take a person there, they have their beliefs, they have their biases, you put them into a Fed building, they're still the same person. So The Fed is definitely a political organization, but to be fair, all people are and organizations are. So I wouldn't worry about the Fed being too political because that's the way every organization is.
If I told you Besant was going to be the Fed chair in a month, whatever, however they would get there, or Jerome Powell quits or whatever it is. And if I told you he was able to get rates in one foul swoop down to 1%, where Trump would like them to be, what happens to the curve in your view? What would your base case be for the 10-year?
We just have a bull. I think the whole curve would shift lower,
Just
and
bull
I think,
But
yeah, bull
you think the
steepening.
front end would come down way faster? So the 10
Yeah.
might go down by, what do you think, 50 basis points or something?
So now there's two schools of thought on this. One school of thought is that you cut rates a lot, long end blows out because everyone's afraid of inflation.
Yeah, that's my point. Yeah.
I think that's the wrong way to think about this because if you have the Fed who's politicized and cutting rates to 100 basis points, why can't they just go out and buy the long end then, right? So that seems kind of silly to
Well,
me.
that's true. Right, right. So you're saying
Yeah.
that they drop rates and start QE again.
Yeah. I
Huh.
mean, if you have a Fed that's under the orders of the president, they're not going to be like, "Oh, sorry, boss, we kind of blew it," right? They just go and fix it.
Yeah. Yeah. Why
Then
not?
what you get is a weaker dollar.
Yeah, that's because, just to explain that, because the interest rate differential would change dramatically. So we'll just use the ECB as a broad proxy for that, because the DXY is 57% euro. So what's baked into the DXY being at whatever it is right now, 98, let's say, is the Fed funds being at 4.3 and the ECB being at 2. So if all of a sudden, out of nowhere, you drop that 4.3 down to 1, to where now it's 100 basis points below the ECB, that means, I think the dollar, in that case, Joseph, I'll bet you it would go from 98 down to, I mean, it would have to be low 90s, don't you think? Or do you think it
I
would
think we
be
go to
eight?
70.
Maybe the 70s?
Yeah, yeah.
Really, if they drop to 1%?
Yeah, I think we go to 70. I think it'd be the biggest dollar devaluation you'd ever see.
Wow. That's okay. So if it goes down to 70, then what do you think happens to the CPI? Do you think, and the reason I say that, just for the audience, is because the argument there, or one argument could be that because the dollar loses so much purchasing power against other currencies and so much of what we buy are imports, then the price of those imports denominated in dollars would go way, 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 way up. And that would create consumer price inflation. The pushback there is we did get down to 70 or 75 in, was it 2012, maybe 2011? And we didn't see a huge spike in the CPI. Now, maybe the argument is that prices were higher than they otherwise would have been. I don't know. You can't prove the counterfactual, but that would be kind of the two arguments there. So where would you land in that debate if the dollar, the DXY, goes down to, let's just say, 75?
Well, there's a lot of moving parts here. Now, one thing I think it's important to note is that a few decades ago, our largest imports were energy, right? Now today, we are the world's largest producer of energy. So that channel there is it doesn't exist anymore. And we also are a huge producer in food and agricultural products, so forth. So that's something to keep in mind as well. But listen, if we had a huge devaluation of the dollar, the stock market will be cut by 30%, and everyone would not have enough money to buy stuff. So I don't think we'd have inflation, actually.
So why do you think the stock market would go down? Because you would think that if the dollar goes down, people go into the stock market as an inflation hedge. Interest rates are lower, and everyone thinks that lower interest rates automatically means higher stock prices. So what would your argument be for stocks going down?
Because all the foreigners would get out. You'd have a situation where you have massive capital flight, and when the foreigners leave, they'll take everything down. And it'd be like any classic financial crisis, Southeast Asian financial crisis or something like that. Foreigners are like, holy shit, my dollar is going down 20%. I got to get out. So, everyone.
Because of the FX rate, just to be
Yeah,
clear for the audience, because if
yeah.
your expenses are denominated in euros, and let's just say it's trading at par, and all of a sudden it goes down to 75 cents, the dollar, against the euro, then all your dollar assets just took a 25% haircut
Yeah.
relative to the currency that all your expenses are denominated in. And at the end of the day, that's all that matters. So you're just like, hit the bid, hit the bid, hit the bid, get me
Yeah.
out of here, because I don't want to take any more pain, and I don't want to risk that the dollar goes down even further against the euro that I need.
Yeah. And that will have a tremendous, I think after this recovery, you could have a large bout of inflation. You could have people use the stock market as an inflation hedge. But that I think there's a sequence here.
Huh.
So you have to see globally, foreigners like U.S. assets, tremendous amounts of exposure to U.S. assets, U.S. dollar assets here. So they are going to be very sensitive to that.
But then you think that bonds go up in price, bonds go down. So then, do you think there would be an argument from the Trump administration to go ahead and do that, just because I guess there could be a narrative that that would be better for the debt, in the sense that it drops the interest rate expense, and then you create consumer price inflation. So hopefully tax receipts go up in lockstep, and the deficit doesn't go up. So then you reduce debt to GDP.
Well, I think we have to keep in mind that a lot of the spending we have, it's just entitlements like Social Security, Medicare. That stuff is like indexed to inflation. So you can never inflate your way out, because the more you inflate, the more expenses you have. So it's a hard. I don't think that's a viable path.
Yeah. Wow. So it sounds like you think the probability, even if Basent gets in there, of them doing whatever Trump wants is almost zero, because
Yeah,
it would be catastrophic, or it
yeah.
could be, and they don't want to roll the dice there.
I don't know how they perceive the world, but I think Trump has a habit of shooting for the moon and settling for something less, right? So we saw that with the tariff negotiations. We'll have Liberation Day. Everyone is going to pay us everything. And then now it's like, 15% is okay as well. So, we'll ask for 300 basis points of cuts. Maybe we'll get 100. And I think that's actually pretty reasonable.
Yeah. Well, I'm just trying to think through what gold does. Gold goes to
Yeah, gold. No,
Woo!
it's
Gold
not
goes
just it's not just in
5,000
rates, but
almost. If they in that scenario that we were talking about.
no, no, no. It'll go up like thousands,
Yeah,
and
so
we
let's
have
say gold
some
goes to 5,000.
at least, yeah. But we also have geopolitical risk too, right? We got some tweets today. The president sending some nuclear submarines over there towards Russia. Now, I don't know enough about the Russian culture or politics, but that strikes me as unwise. So, you can go and you can bully like the European Union and Japan and Canada, so forth. Those guys, at the end of the day, they are honestly that they're kind of part of the empire. But I mean, we have military bases in those countries all over the place, right? So you can't really say that you are just kind of a fully sovereign country. Now, imagine if you were the United States and you had like German military bases in Texas, right? How would you feel about that? Oh, you would feel like you were someone who being occupied by a foreign country. But
At the very
the
least.
United States has foreign bases in all these other countries, and so when we go and talk to them about trade, that's a lot of negotiating leverage there. But using the same tactic against the Russians, who I think, you know, like any other country, are proud and have their own military force. And I think more importantly, looking over the past decade, I think the Russians probably feel like the West is not someone they could trust, since we had all these I don't know agreements and things like that weren't honored. So I don't know if this kind of approach is wise. And so I think that's some meaningful tail risk that the market is not really appreciating today.
Huh. So what the hell do you do, Joseph, if you're someone like a retail investor that's trying to get your head around this, and first and foremost just doesn't want to lose money? And it'd be great if I could make some, it'd be great if I get some return, but I just don't want to get wiped out. And you're sitting there looking at the stock market that, yes, it's all-time highs. I think it took a hit today, but the PE ratios are at nosebleed levels. There's really, it's a difficult fundamental argument to go long the S&P right now. And you're looking at real estate that's close to all-time highs, but that's kind of teetering on the edge, especially when you look at states like Texas and Florida. You look at gold, that's kind of a no-brainer, but gold is at all-time highs, right? And you look at commodities and you're like, I don't know if I want to be in commodities. I mean, I like that long term, but short term, Who knows what's going to happen? We've got a lot of risk, let's say, not just geopolitical, but risk to the economy, especially when you consider the softening of the labor market. And it's like what on, and then for most people, I don't think they really want to go into bonds because, they're worried about the supply issues. I'm someone who's not worried about supply expectations of bonds because I think it's more about growth and inflation expectations. But as a retail investor, I get the argument. It just seems like there's literally nothing they can do but just be in all cash, and then they're just going to get run over, even if the inflation rate is at 3%, because compounded over a few years, that's real money. So I mean, what the hell do they do?
Well, interest rates are, you can get 4% in your money market fund. That's pretty good, right? You do nothing and get 4%. That seems like a pretty good deal to me.
What do you think about long dated tips?
I haven't looked at them. What are they offering right now?
I think I saw the 30 years at 2.5.
Well, you don't ever want to buy anything that's 30 years. You have no idea what's going to happen in the future. I would look at that, let's say 5 years.
Uh,
Looks like it's like 1.3% in real yields. That's kind of low.
mm-hmm.
Better than nothing, I guess.
Yeah. So the bottom line is you're someone who's like, well, there might not be any great alternatives, but a decent alternative.
So, one thing that I think is if you just have a bunch of cash, you can just go buy like a single family home, rent it out, cash on cash, you get 5%,
Mm-hmm.
and you get to have depreciation against that, so you won't have to pay interest. So I think that's a pretty good investment.
Yeah.
It's kind of like having tips, right? Because that property will go up with inflation, and maybe your rent will as well, and depreciation aspect as well. So maybe that's if you have like $500,000-$600,000 increments of stuff to do, but otherwise, cash at 4% seems to be a good idea as well.
Yeah. And then what do you think about precious metals? Is that just
Yeah, gold, of course, as we've talked about. There's a
just
lot of good
because even though it's
tailwinds for
an
gold.
all-time high, it's just the tailwinds are so strong
Yeah,
that
yeah.
you got to have it.
Yeah. Well, it's been consolidating for the past few months, right?
Yeah.
So I don't know what the future is, but oftentimes, well, not oftentimes, sometimes when you have this kind of price action, you see it consolidate for a few months and it can move higher.
Yeah. What's interesting? I think today it was up 2%.
Yeah. Yeah.
So
It's because
you
that
would,
jobs report, you want to know weak jobs report means rate cuts, means weaker dollar, means gold go up. And so if we do fall into recession, gold is going to go up a lot.
and what do you think about the copper to gold ratio? Because I know that really blew out today because gold was up, copper I think was way down. So do you put any stock into that?
No, I mean, this is not math. This is not physics, right? There's no universal physical law that you have to have some kind of gold, copper, or gold silver ratio. That obviously doesn't make sense to me. And copper's down a lot because President Trump changed how he's going to do his tariffs, right?
So there's a lot of variables there that are
Should
outside
you
of just
should you change your gold allocation because Trump changed his tariff policy on copper? That doesn't seem to make sense.
No, I wasn't saying that, but what the gold copper ratio tells you about the economy. Because theoretically you got Dr. Copper and then you got gold that's kind of like a risk off thing against kind of uncertainty. So if you have gold going up, you've got a lot of uncertainty. And if you've got copper going down, it's kind of a broad proxy for the underlying economy. So if you have that ratio blow out, then that tells you that things probably aren't too good.
So I never want to use ratios, whether it's PE or gold, silver, or whatever, because these things are always changing. Now, copper as an indicator of the economy, they used to say on CNBC, oh, Dr. Copper has a PhD
Yeah.
in economics.
Yeah.
But, a lot of that is what's happening in China. Right? China is the largest consumer of copper. How is their economy doing, right? And they have their own internal problems with their, real estate bust and so forth. And you could have changes in the economy where suddenly you have, maybe greater demand for electrification, that leads to greater demand for copper. So things are always changing in the economy. The future is not like the past. So these ratios don't work because it's not a physical law. It's not physics. It's always context and judgment.
You don't think overall S&P 500 PE ratios tend to mean revert?
No, because I know they don't. I mean, draw a chart. It goes up sometimes, crazy high, then it goes down a lot, crazy low. There's no mean there.
Yeah, you don't think that there's an average. So if it's below, let's say 15%, it implies that it's a good time to buy. And if it's above, not 15%, 15, and if it's above 15, then it implies that it's a good time to sell.
No, because when it gets expensive, it can continue to go more expensive than you can ever imagine for longer than you can ever imagine. And when it becomes cheap, it can go super cheap longer than you can. I mean, these value investor guys that look at the world that way, they just haven't been doing well the past decade because it doesn't work.
Yeah. It's funny you say that, Joseph, because I was at an event with another good friend of ours, Chris McIntosh, and this was in Dubai, and it was maybe a year ago or so. And there was a guy there that's good buddies with McIntosh. That's a real famous trend follower. I won't say his name. And, I always have that view that like you want to buy things when they're cheap, you want to sell them when they're expensive. I guess you could say kind of a value investor mindset. And I was talking to him, and he was big fans of Jim Rogers. And I said, well, how do you really do that? Because he's like the ultimate value guy. He's buying Uzbekistan and North Korea and all these crazy places. Jim Rogers is, right? Where this guy, he's just trend following.
Momentum, yeah.
Yeah. And I said, but then we got to talking, and we were talking, having a couple of drinks there. And the conclusion we came to, just to try just kind of reconciling everything, is that at the end of the day, everyone is a trend follower, even the value guys. It's just the value guys that do really well, like Jim Rogers, they look for deep value, but they have to have a catalyst. They always have to have a catalyst. So they'll never, ever, ever buy something just because it's cheap, or they'll never, ever, ever sell something just because it's expensive. There's always a catalyst. And I said, okay, well, this actually makes a lot of sense, because if you're a value investor that waits for a catalyst, in essence, you're a trend follower, right? So maybe that's how we can explain how some of the value investors have done exceptionally well, and how a lot of times the trend followers in the right market do better over a long period of time.
Sounds good.
Yeah. Okay, buddy. What are you doing right now? Where can people find you, and how's the YouTube channel doing?
Oh, it's doing well. So, guys, if you're interested in hearing what I have to say, every week I put out a video on my channel. It's called Joseph Wang, where we go through what happened in the markets the past week. So, I'll put up a video every Saturday morning. So tomorrow, I guess I'll talk about all this cool data we got the past week,
Yeah,
and of
cool.
course, what the president may or may not do.
Yeah. Well, I can assure you one thing, Joseph, it'll change a lot from today to tomorrow morning. Whatever the president is doing, it's gonna be unexpected, I think, and it's gonna change a lot. Who knows if he's gonna do a 180? But the good news is there's always a lot to talk about. There's never a dull moment, right?
It's great TV.
Yeah. All right, buddy. Have a good one. We'll talk to you soon.
Talk to you soon.